Welcome, internet people, LinkedIn followers, LinkedIn audience, everybody that tunes into any of our stuff. Today is another video where you don't simply have to listen to Arthur ramble on for 20 minutes, where we've got a wonderful guest, an old friend of ours. So again, this is Arthur Petropoulos, managing member, founder, Hillview Partners, middle market, lower middle market investment banking firm, selling companies, finding companies capital. And today we are joined by an old friend of the firm, Greg Matthews, a principal at Anacapa Partners out in California. And despite the fact that I have aged far worse, an old intern colleague of mine from long back in the day. So, Greg, thanks a lot for joining in here today. Appreciate it.
Yeah, thanks so much. It's good to do this with you. I really appreciate it.
Likewise. So, Greg and I, back in New York City, circa 15 years ago, used to walk up and down Madison Ave, drinking coffee, spitballing ideas, and who would have ever thought that now we could subject the rest of the world to our philosophies of life? But this is good. But Greg, if you don't mind, as a quick
Yeah,
intro, you mind just giving a kind of rundown, your history, background, what you do? Greg, obviously, for everyone that knows Anacapa, is a middle market, lower middle market, private equity firm. But we'll let you give kind of a quick rundown of yourself and the firm and all that good stuff.
yeah, absolutely. So starting with myself first, as Arthur mentioned, I started my career in Wall Street. I worked in securities trading. So I worked at Merrill Lynch for a number of years in the fixed income department. Then I moved to Hexagon Securities, which is a startup broker dealer kind of in 2008 with the void of Lehman and Bear Stearns. That's where I met Arthur. And there it was a credit focused broker dealer. We traded all different securities. And then we also did some typical capital market raising, both equity and debt, mostly for financial services businesses. Did that for a number of years, and I was kind of hired as a jack of all trades under the founding partners. And I realized I really liked working with people, and I liked more of the management side of things and more kind of getting into the operating side. So I went back to business school and I raised money from investors. I looked for 2 years for a company to buy and run. I didn't wind up purchasing a business through that venture, but some of my investors connected me with Jeff Stevens, who's the founding partner of Anacapa. And at the time, Jeff was looking to bring on kind of his first junior hire, and that was 9 years ago. And I've been at Anacapa ever since.
Very cool. Did you find that the middle and lower middle market, uniquely captivating as you were kind of getting out into the world, or was it
Yeah.
kind of just that you stumbled into that space, or what was kind of the thought in that regard in terms of, I guess, market sizing focus?
Yeah, a little bit of both. I mean, at Hexagon, there was definitely some exposure. I'd say the low middle market. A lot of times we were working with entrepreneurs, first institutional money, and they were coming to Hexagon to raise. So I saw a lot of companies there that had a really good concept, didn't have kind of professional financing behind it. And that's very analogous to what we do. Vast majority of our companies have no institutional money, and we're the first money in.
But when you look at something, is there something in particular or a rubric, a lens that you look at to say, okay, this is or is not buyable before you kind of really get too deep into the weeds, just kind of from a sniff test perspective, how do you look at businesses?
Yeah, that's a great question. I think, Anacapa, we have a pretty specific framework. So when we think of something's viable, there's probably the one kind of guiding factor for us is predictable revenue, right? We kind of know what we're good at, we know what we're not good at. And so we're not turnaround people, we're not venture investors, we're really not even great at the early stage of growth equity, just because we're a lot better suited to buy a business with a proven model. Ideally, if that revenue is predictable, it also really helps with what we're doing, which is transitioning in a new entrepreneur.
I guess outside of just long-term recurring contracts, how do you kind of look at the sales function of a business and say, okay, we can get comfortable with the revenue generating machinations or processes here?
Yeah, I think it's a little bit of qualitative and quantitative. So on the quantitative side, looking at historical sales data, ideally there's some history to that. We can look at year over year trends, and more importantly, look at the existing customers, understand their performance. Ideally, they're renewing and hopefully at a larger kind of spend every year. And also they're landing new customers. I think on the qualitative side, once you have that data, it's really sitting with the key people in the company responsible for sales and understanding how that process unfolded. And ideally, what we're looking for is a process.
No, that makes a lot of good sense too. And do you care necessarily like how they're getting their sales as long as it's a repeatable process? Like we've seen buyers sometimes that say like, we only want to buy a company if they're doing X amount through kind of like digital outbound or social
Hmm.
ads. Whereas we've had other people that say, I don't really care how they make the sales as long as it's predictable and repeatable. Because there are a
Yeah.
lot of businesses that like they don't do much of any
Sure.
online anything or any outbound. It's just kind of old fashioned, like hammering the phones. And then we've seen others that just do outbound email. But how do you think of like the channel from which sales is coming from?
That's a really good question. It differs on the companies for sure, right? Because a lot of our companies are founder kind of driven, where that founder's been kind of grinding out sales for 20 plus years in the industry. And so his or her presence brings in a lot of that, right? And so there, that's something where we're looking for, okay, even if the founder is still integral, are there people below him or her that support kind of servicing these sales? And do I think there's at least some sort of process that we can go out and get more when that founder kind of steps back? Most of what we're investing in, I should have mentioned, is B2B. So there
Yeah.
is digital marketing and stuff like that, but it's very different than B2C businesses.
Yeah. When you look at the execution or fulfillment process of a business, like in terms of like just the provision of services, whether it's I don't know, providing the software, whether it's remediating dirt, whether it's distributing certain products, like how do you look at that part of the business and say, okay, this one's a good one, or yeah, I don't know about this.
Yeah, ideally that comes from, the repeatable nature of the customers. I mean, if the customers keep coming back to you, it's some signal in the data that you're doing, whatever you're doing is satisfactory or they're happy with it. We do heavy customer diligence. Unfortunately, that's usually pushed towards the end of a process when you talk to the actual customers of the business, just for the sensitivity of the transaction. But a lot of times, what we'll do is we'll do representative customer diligence as early as possible. So, talking to people that should be or could be a customer of the business.
When you look at the operations of a business, being HR, finance, legal, all kind of the support stuff that ties the machine together, how do you look at that usually? Do you just say, hey, is there a process and can we implement one, or how can we make it better, or how much does that kind of weigh into the overall calculus?
We always expect some level of professionalization just by nature of, like you said, we're the first institutional money in. At the same time, we're bringing in a new manager of the business, and we don't like to make a lot of changes very fast. I think that's one of our core tenets is like go slow, earn the trust of the business. But a lot of what we're doing is heavily professionalizing the business. So it's a little bit of three areas. It's people. So typically, like we're bringing in more people to all kind of different functions, and we're kind of figuring out, how should these be organized depending on what we want to go to the market. I think the second piece is typically putting in KPIs, or at least really getting into what are the key KPIs to measure, and then kind of setting short-term, medium-term, long-term objectives against those, right? And that's where it's a lot of organic growth and things like that, and making sure we're growing in a smart way. And then the third piece is depending on the business and depending on the opportunity.
Do you find that having the imprimatur of like a private equity firm over something and that kind of institutional capital allows you to get better talent when you do go out to look for people as you kind of build up the infrastructure of the business?
It depends. It depends. Like I think there's definitely advantages, right? In terms of you potentially have a higher budget to hire and you have maybe a wider network to cast, or you have resources like recruiters you can lean on and things like that. Some talent gets excited by the prospect of having the potential for like equity ownership or something like that. And typically, if you have a private institute like institutional investor, they've thought about how to kind of like build that out in the cap table. But really, I think a lot of it comes down to the culture and the CEO of the business. Like the most important thing our CEOs do is hire, and that is their most critical job. And I think the ones that really excel at that just do a phenomenal job selling the story. And I think it's a lot of just their vision behind that and the culture they have in the business.
Yeah. How do you kind of sit down with management and you say, okay, I think these are going to be good partners, or hey, you know what? Let's
Yeah.
avoid this gang here.
Yeah. Yeah. I would say because on the side where we're in working with searchers, we have the benefit of we've known the searchers for a number of years. So I think our relationship with them is very strong, although we haven't known them as a CEO, but we have a very high conviction of backing them in that. And so a lot of times there with the existing management of the company, we'll make sure the owner is up for that transition and supportive of it. And I think that's the best we can do in that case. And sometimes if they're key to the business, we'll think about ways to incentivize them and retain them. And there's economic ways to do that. And there's also kind of cultural ways to do that. And then the people below who are going to kind of be kind of key in the execution, those people we spend a lot of time getting to know. And so who are kind of the next two or three employees, the next layer down that are critical to the business? How can we incentivize them? Sometimes it is through equity ownership. Sometimes it's through, you know, looking at the org chart and figuring out like, what sort of room for growth is there in their professional career journey.
How do you value a business? But generally speaking, as you kind of
Right.
approach, so you say you look at all these different pieces and the processes, the people, what they do, what they sell. How do you start going around kind of sharpening the pencil? Because I'd say that's the number one question that people ask us. And obviously there's some metrics relative to EBITDA multiples and things like that that guide it. But in that
Mhm.
kind of somewhat science, somewhat art of the exercise of valuing a business based on all these things, how do you kind of go about that exercise?
It's a good question. I mean, the way I look at it is I look at the business, I kind of look at all those aspects we just talked about. I'll kind of think in my mind what's a base level 5 year projection for the business, assuming kind of all those things stay put or don't change that much from what we've talked about. And I'll kind of come up with a base case scenario, and then I'll see if that's going to hit our return threshold. And from there, I can start to decide, what we need to price, what we would need to buy the business at to make sense for us.
Do you find that when you guys take step into a business, and I always kind of think of like the airplanes. You ever see like the videos on YouTube where it kind of like comes off the cliff and like a short
Yeah.
runway, then it kind of drops a little and then it kind of catches
Yeah.
itself back up.
Yep.
Do you find that kind of stepping in, you want to kind of bake in some, I guess, time period to kind of get that velocity behind you or that momentum?
Yeah. If you looked at our data, I would say revenue always goes up because ideally we're buying something that has a pretty durable model and ideally a market that's also growing. So we have kind of a natural tailwind behind us. But our EBITDA almost always dips.
Interesting.
And that's usually a function of we've had to put more expenses into the business. So it's mostly people, but a lot of times the businesses are just underinvested in. And that's normal. That's part of the professionalization. But we expect EBITDA, to your point of the plane analogy, to kind of go down. And then ideally after 12 to 18 months, we're figuring out, okay, like what's our set cost structure for like the major cost items, and then we could really accelerate. But that is very common that we do have a dip.
I guess the last question as part of that to wrap up this, what kind of
Mhm.
duration do you typically contemplate? Because obviously private equity, you're buying, you're holding it for some period, and then you're often selling it to strategic, another private equity or whatever it may be. But when you're kind of modeling in that valuation, are you typically looking at a 3 to 7 years? Is it longer? And then if it exits sooner, it just happens? Or what do you kind of guys pencil towards typically?
5 years. I think
Okay.
um, a lot of that's just the thought of, beyond 5 years is really hard to forecast with any level of certainty. Even 5 years is really hard, but beyond 5 years gets really hard. And shorter than 5 years, I think just given kind of the work we have to do, we find that time frame's hard to execute all that. That's not reflective of our holding period. I mean, there's a lot of businesses we've held longer than 5 years, and frankly, like if it's a good business and we've kind of hit the sweet spot where we are operating really, really well, and we feel there's a lot of market opportunity. I mean, we'd much rather invest behind that than probably take a new risk on a new business. So I do think we're really comfortable. We have some that we've held, going on 10 plus years now.
Very cool. All right, good. Well, this is the end of part one of Greg gracefully subjecting himself to the Inquisition of Hillview Partners. Next video,
Yeah.
we're going to dig a little bit more into kind of the inner workings of the deal and kind of how certain things are structured, how you like to look at different parts of the deal, and then just some general kind of reflections on the good, the bad, and the ugly along the way. But really appreciate the time, Greg, and looking forward to the next chat here.
Well, me too. Thanks, Arthur.